Thanks everyone for listening in, by the way. Yeah, my name is Valero, as already introduced, co-founder of TowerDex. You have not heard of us because we're actually public announcing tomorrow, so I guess there's some alpha. On stage here are around 5 billion of TVL, so if you are hearing me but you're not in this room, you should really come in here. Maybe we can have a round of introductions, everybody by themselves, while I try to get us more microphones.
Hi, this is Catherine. I'm the head of BD for Solv protocol. So you may know it from zenBTC. We are a on-chain Bitcoin reserve, and then we're also one of the Babylon liquid staking, and our asset is zenBTC.Babylon. And very happy to be here today. Thanks.
Hey everybody, my name's Adi. I'm the head of BD at zenRock and zenBTC. We're a decentralized yield-bearing wrapped Bitcoin product focused on high-performance chains, starting with Solana, coming to market in March. So look out for some announcements there. I'm also a principal at a growth equity fund called 10T.
Hey everyone, my name is Jacob Phillips, one of the co-founders of Lombard. Lombard is a Bitcoin liquid staking protocol built on Babylon. More fundamentally, you can think of Lombard as a Bitcoin bridge from BTC L1 to other ecosystems. So you can mint LBTC on ETH mainnet, Base, BNB, Solana, Sui, pick your favorite chain, and LBTC is integrated within all the sort of big DeFi apps. So you can use it on Aave, maybe soon MakerDAO. Yeah, I'll pass it to Clayton.
Yeah, and I'm Clay. I'm the head of BD at Babylon. Babylon's a Bitcoin staking protocol that also offers security to other chains. So, we natively allow people to stake Bitcoin on the Bitcoin network and allow that asset to be used as security on other proof-of-stake ecosystems or rollups.
All right, cool. Thanks, everybody. Is this on? Yeah, I think so. All right. So the first question to kind of just start us off, because BTCFi obviously has been a topic that's coming up, but is BTCFi actually real? Is BTCFi a thing?
Maybe I can take this one first. I feel like you posed the question that way, expecting somebody to come up with a hot take here. I don't think this is a hot take, but Bitcoin DeFi is sort of, I think, an articulation of a trend we're seeing in the crypto space, not necessarily something totally separate. Like, there is DeFi and there is Bitcoin as an asset within decentralized financial ecosystems. There is not necessarily, or there does not necessarily need to be a separate BTCFi. And in fact, I think usually when we separate the two, we miss the underlying point, which is users want to use Bitcoin in cool applications. I get most excited about the applications that could merge the two, using BTC in Hyperliquid, or using LBTC on Aave, or to trade options on Derive or something like that. That I think is where it is. So over time, I think there is BTCFi right now, but over time, this will just shift into DeFi. Another way of thinking of it, we don't need to recreate the entire DeFi ecosystem just because we have a new asset.
I mean, I think everyone's pretty excited about just bringing Bitcoin into DeFi broadly, and it isn't just another asset, right? You're talking about one of the greatest assets of all time. This is premium collateral for the first time that you can use in borrowing and lending protocols. I mean, that itself is just insane. We've been in this industry for 10 plus years now, but you've never been able to use Bitcoin in DeFi. How absurd is that? Now you're finally seeing it come true, which is just really exciting. And I think it's just the start of the first inning. Maybe we're just in warm-ups now of using Bitcoin in DeFi, using Bitcoin to secure other proof of stake chains.
Yeah, I think I'll probably just add on to it. I think Bitcoin, I think a lot of people traditionally seeing it as an asset that just sit around, right? So what I think everyone trying to do here is trying to put it to work. And I think the value proposition is strong. I think it doesn't actually take too much of a convincing, because the yield on Bitcoin, probably jumped the gun on a question here, the yield of Bitcoin native yield is 0%. So anything greater or equal to zero, you could potentially move a lot of money. And so I think the total addressable market is actually huge, and then it wasn't a thing that you can farm ecosystem with Bitcoin, and it's actually Bitcoin as an asset because it's always appreciating. For people that looks for TVL, if you have 1,000 Bitcoin, like a year ago, it was X amount of money. Now it's $100 million, right? So farming, I think, is actually a very decent use case. But more importantly, like collateralizing Bitcoin is a very like premium asset to collateralize, and that kind of opens up a lot of DeFi primitives and probably the CeFi primitives as well. And so very optimistic about BTCFi, or what I like to call it, Bitcoin finance. Yeah.
I would say it makes sense to define it as something unique because of its size, and also to acknowledge that it was actively happening before you started to put it on decentralized rails, which I mean, like removing the D from BTCFi is kind of annoying because I mean, if you're talking to an exchange, the majority of trading fees that they're receiving is through like the volume that they're having on a daily basis on from trading Bitcoin. I think it's smart to like name it something else though, because I mean, if you're looking at doing DeFi stuff on Ethereum, it's Ethereum, stablecoins, ERC20 tokens. You can only send and receive on Bitcoin network, so there is some unique aspect to that. Like as Jacob pointed out on the bridging side, this needs to exist elsewhere. There is some form of things that you need to consider because it's not necessarily native to the chain that you're doing this on. That being said, the addressable market is gigantic, right? I mean, if you're looking at the market cap of Bitcoin, if you're looking at the amount of Bitcoin that gets used both on-chain and off-chain to buy other assets for yield farming, you can kind of remove that function from everything, and then everything actually does just exist in a decentralized way with Bitcoin as the underlying collateral for any sort of yield opportunity.
Okay, so Catherine, you actually touched on that about the question of yield with Bitcoin. This panel is obviously called HODL to yield, and I think a question I have for this entire panel, we've seen nation states, we've seen massive asset managers, we've seen generally institutions acquiring Bitcoin, generally in a way where there doesn't seem to be a massive intention to actively use it. Maybe staking, this has happened actually, so this is a great onboarding ramp. But do you think that this trend of like big players essentially feeding into this scarce gold narrative is beneficiary or actually a problem for BTCFi, BTC DeFi, the actual active usage of Bitcoin as an asset?
This is something we actually published an op-ed on Cointelegraph. I think says exactly that. Like as countries coming to hoard all these Bitcoins, for the price perspective, I think it's good. It's gonna make it more scarce. It's gonna drive the price ever higher. So that's good for us, I think. But on the other hand, it's almost essentially taking them out of circulation, and those Bitcoins sit there. And is it good or bad? I think I think when Bitcoin was first created, it was always meant to be people. It's meant for the people. It's permissionless for you to buy and sell. But now, if nations are hoarding it, is it actually against the original spirit for Bitcoin? And then it just make it sit there more. And so I think I have no answer for that, but imagine if there is a Bitcoin reserve that is yield generating. That could be potentially our opportunity. I think yield generating value proposition, I think it's still very strong. And so that is something that we would be very actively exploring as Solv. Yeah.
I mean, it's a huge catalyst. I think Bitcoin caters to many different groups and sectors between the TradFi world and the DeFi world, and there's room for everybody to hold Bitcoin, right? Whether it's nation states, asset managers. I think as it relates to Bitcoin Fi or Bitcoin and DeFi, it's a completely separate group of people that are operating on chain. And that's okay. Asset managers that hold $100 billion in AUM don't need to be on Aave right now, and they won't. They're just finally getting okay with holding Bitcoin on their balance sheet. Same with nation states. It'll take time for them to go in and deposit collateral into Aave. I think it'll come maybe in the next 5, 10, 15 years. I don't know. But the risk appetite just now for them to hold Bitcoin is a massive unlock for this entire industry. And the tailwinds, the macro tailwinds in effect for Bitcoin as a asset for TradFi to hold is something we've never seen before. And also, I mean, we haven't touched on this, but the US administration just changing their view on crypto broadly is incredible for US DeFi. Right now, I think the total wrapped Bitcoin TVL in DeFi is probably around 30 billion if you include LSTs. That's a small number if you think about it in the retrospect of all of the assets in the world, right? So, you know, we have the view that that's probably going to 10x in a very short period of time and go to 300 billion in total TVL. But you know, it's okay. They don't need to be putting assets and Bitcoin in DeFi right now, but I think it'll come. I think for this conversation, it's really for those sophisticated DeFi degens or users that want to loop yield around and use many different protocols, which now you can finally use Bitcoin as an asset for.
I just have one quick thought, and then maybe I'll pass this over to Clayton because I think it ties into his. While I agree that you know, not $100 billion asset managers maybe aren't playing around on Aave and Uniswap at the moment, I do think all of these guys, and I know because we're talking to them, are interested in the idea of putting their Bitcoin to work in some use case. Particularly like staking, I think is the easiest one to pitch. You can't even go pitch them like all the crazy stuff we're doing in DeFi to start, or you'll scare them away. You've got to start with something like really simple, easy to understand. Maybe they're already doing it in the ETH ecosystem. It's a risk they can get comfortable around. Like with staking, you're only taking on technical risk. This is the kind of thing that I think is a great onboarding mechanism for these parties into the on-chain world. And then my one other thought was, I think we just need to activate Bitcoin in any form. DeFi, CeFi, something in between, hack together. The goal of DeFi is to build these trustless, battle-tested mechanisms that anybody can put their money to work. Like one of my thoughts on DeFi is that you're just massively ramping up the capital efficiency of all capital on the planet. Like a lot of dollars in banks, I guess, are put to work and rehypothecated. Right now, all your crypto assets just kind of sit idle. Imagine when you can rehypothecate those 10 times over safely because we have on-chain mechanisms to do so.
I mean, forever looping Bitcoin sounds pretty cool. I think the reason why we started with staking, and this was from me deciding to join Babylon, but it's a layer that has been used by everyone, and whether you want to call it DeFi or something else, it's one of the few transactions that people do where there is some sort of reward given to them. And it's a familiar experience for everyone at this point in time, especially looking at the transition from Ethereum going to proof of stake, and then a lot of chains like Polkadot, Solana, Cosmos chains, etc. You do have 5 to I would say 5 years of institutional education around proof of stake and the nuances between DeFi yield and proof of stake rewards. And so getting them in the door on having a reward rate attached to holding an asset, understanding the risk, gets them more comfortable with doing things beyond that eventually. And I mean, you would be surprised at people that you talk to here, because they are doing it all off-chain, right? Like they are earning yield on their Bitcoin. It's just not represented in any form of fees that are being sent back down to the base layer. The same way that the reason why institutions are staking Sol is because 42069 dude launched PP Bitcoin on Pump.Fund, and he's getting a portion of that because he's staking Sol and validating those transactions. So I mean, eventually they'll get to this understanding of this cyclical thing, and it actually being cheaper for them because everything's decentralized, to where they do want to start doing things more on chain because they're getting a revenue they're getting a kickback by supporting the network through staking.
I do appreciate that Bitcoiners adhere to the principles of DeFi, I think, more than holders of other assets, in a sense that it might be that to unlock some large proportion of Bitcoin capital, the only way we'll be able to do it is with trustless mechanisms. Most other assets you can kind of hack together some multi-sigs, and people sort of view them as a risk-on asset. But for a lot of Bitcoin holders, it's if you don't have something on chain that's verifiable, that executes trustlessly, I'm probably just never going to use my Bitcoin.
Yeah, I do want to actually double tap on and play devil's advocate for a second, right? So if we assume that nation states and big institutions actually acquire Bitcoin to significantly more rapid rates than currently, is anyone going to actively use their Bitcoin for 5%, 10% of yield if the asset appreciates by 30, 40% a year?
Yeah.
This is specifically supposed to be spicy. You think so?
I mean, are you saying that why do anything else when I know I can get something?
Well, my argument is, and I'm curious to hear the thoughts here, is that if the base asset is very appreciating, at least in traditional economic theory, you don't want a currency that is deflationary, because that actually takes it off of circulation. You have baseline small inflation in order to incentivize economic growth, adopting that to the Bitcoin principle. If you have a ton of nation states, and I actually think staking is not part of this. I think staking is gonna be the primitive they're gonna use. But besides that, for liquid staking, to the three in the middle targeted, how do you see that kind of playing out? Do you just think it's never gonna reach that level where it's really gonna be 40% year on year, or do you think that yields on chain might actually reach those levels?
So I think you're right in that. If I'm making 30 or 40% on a volatile asset, I'm not going to go gamble it away. Like if I'm printing off this asset, there's no reason for me to take a risk. However, DeFi and programmability build so many more mechanisms for you to put this to work. There'll be very, very risk-off mechanisms that'll be like staking, for example. At this point, staking is viewed as like basically the risk-free rate within DeFi. That'll obviously be a use case Bitcoin holders will get comfortable around. I think battle-tested protocols like Uniswap and Aave, Bitcoin holders will get comfortable around. And then there's a whole suite of like programmable applications of Bitcoin on top of this that people will want to do with their Bitcoin, even in spite of this. Like even just like fast payments on Sui. That's something you can't do with Bitcoin right now. Well, I mean you can, but you're doing it on Bybit or something, right? So I do think that people will build these sort of mechanisms to collateralize Bitcoin and to allow for just more liquidity, faster movement of Bitcoin. That'll still be attractive even if Bitcoin's printing.
Yeah, I mean, I think it's just your risk appetite at the end of the day. Some people will do it, some people won't. Nation states probably won't. Big asset managers might if they get comfortable with it. There will be a lot of ways to generate and loop yield around if you want to go more into the risk spectrum. But a risk-free rate on staking Bitcoin is probably the best way to get yield, probably the most safest. I think a lot of asset managers are going to look into counterparty risk. What is the exact way you're securing the Bitcoin that you hold as an asset issuer? Is there risk in the multi-sig? Is there risk in the underlying MPC or whatever you're using from a security principle? I do think they care about it. I don't think your regular degen really cares at all about security, but maybe your institution that has a lot of LP capital might.
Well, yeah, I think I'll just add on one bit. I think as corporations and countries are getting more and more comfortable adding Bitcoin on their balance sheet, I think that's a huge step one. And I think that almost the next step for us is probably thinking about collateralizing them for cash flows. So that would be something that I personally envisage.
Yeah, I'm happy to hear his opinions. As a DEX, obviously, I agree with you guys. So another question is that for stablecoins, generally the thing that people care about the most is distribution, generally, and composability, over decentralization and yield specifically. Do you see a similar trend for Bitcoin, or do you see it playing out a little bit differently?
I mean, I could add there, absolutely. There's a reason that WBTC still has majority of the wrapped Bitcoin TVL right now. It's trusted, it's tried, it has a lot of the liquidity generally. I find that USDT and USDC is very similar, but there's a reason that they're on all of the chains now, and any chain that's coming out wants to support that stablecoin. Same goes with WBTC as just a generalized wrapped Bitcoin product. I think that will change. You're starting to see that with yield-bearing stablecoins come out now, and really see a tsunami of capital flow into them in such a short period of time, because users want productive assets and they want to use those assets in DeFi. The same exact story goes for Bitcoin.
I think there's probably more of an appetite for more decentralized on-chain verification tools for Bitcoin than stablecoins. to be honest, I think most people want some sort of like centralized backing of stablecoin because it's supposed to reflect something that's entirely off chain. And I'm sure there's a bunch of like people who experienced holding UST like 3 years ago would probably relate to the experience. So yeah, I think it makes more sense to have a centralized stablecoin still, as opposed to like the tools that you can put in place to at least have some like underlying verification of the asset being held somewhere, someplace. But you still do need to trust an entity at some capacity if you're using a wrapper of any function.
With all these mechanisms, if given the choice between a purely on-chain mechanism where you're trusting, code and math versus trusting some human, in time, everyone will always choose the trustless mechanisms. But it turns out using the centralized mechanisms to create the sort of user experience everyone's looking for is just so much better. DAI back like, what is this, 2018, 19, 20 or whatever, was sort of the dominant stablecoin, or maybe USDC was just being created. I don't know the time frame exactly. But when USDC came out, it just toasted everybody because the liquidity, like USDC held the peg super tightly and DAI was like floating like this. So the usability of USDC was so much better. Same with WBTC and CBBTC, I think. Those are really great products. And I think that like sometimes I do think that long-term trustless mechanisms in Bitcoin DeFi will win out. But in the short term, the most battle-tested custody tech in the world is like Coinbase custody and Anchorage. And I think anybody who thinks differently at this point in time is probably thinking a little bit too principled. I even did this myself for quite some time. And so I think being able to leverage a lot of the battle-tested tech that we have built today is probably the best way to bridge the gap. If we go too far and try to experiment with fully trustless mechanisms, I think either people are just never going to onboard, or we're going to end it into some of these situations where people onboard and then get burnt, and then now all my Bitcoin staying in a cold wallet for sure.
Two observations here. And number one is, after working in Bitcoin ecosystem, I do realize that Bitcoin is actually it's relying on a lot of trust assumptions. It's the asset that people prefer to give it to custodian than having it in a cold wallet. Like there are Bitcoin holders that they want it to be custody. Like this is very rare in terms of other cryptocurrency. The other coins are like not my wallet, my seed phrase, not my coins. Whereas for Bitcoin, it's almost the opposite, especially the earlier Bitcoin holders. This is the observation that I had. And I think in the short term, I think it is what it is. And then I think Solv's role is to make sure they're comfortable. Like I think we're not trying to change it. Like you need to be decentralized and all that stuff. We want to make sure that the Bitcoin holders are actually comfortable, and that is why we work with a number of custodians. And another observation that I had was, so Solv, we had a DPAC event last November. It wasn't an exploit of a protocol. Essentially, one of the whales' wallet was stolen by like a Telegram phishing attack. I think the fisher, he actually didn't realize. I think he was doing is a very rudimentary like a social engineering attack. I think he was surprised that he got so much Bitcoin, and then so he was trying to offload our Stablecoins Babylon, and then it was dumping all on DEXs, trying to offload, and then causing a DPAC, and then so we tried to recover, we tried to freeze it as much as possible, and then I personally was a little bit uncomfortable with that because it's a centralized way of recovering for it, and then but as we talking about like looking at Bybit, the attack today over the weekend, Circle was almost praised for their ability to act it and freeze it. And then for other attacks, when they're slow to freeze it, they're almost getting a heat from that. So I think it's an interesting observation whereby, yeah, like we do advocate decentralizations, but when bad stuff really happens, people actually do rely on centralized measures to like, I don't care, like I just want my money back. And this is just an observation. And as an asset issuer, I do feel like when time happens, a centralized method right now is still preferred almost than the decentralized ones.
I think people are going to appreciate the behind-the-scenes view of an event like this happening, a stressful thing. So honestly, thanks for sharing that. So let's switch for the last 3 minutes onto the topic of yield. You already mentioned this before, but I'll still double tap on this. Bitcoin baseline yield is arguably zero. Is that a competitive advantage or disadvantage to other assets?
So we call it reward rate at Babylon because that's
right. Right.
But I mean it depends, right? I mean if we were having this panel discussion last year same time, I think half the people here would be like, who would want to stake their Bitcoin? We've gotten to the point now where it's like, okay, yes, and then what else? And so it doesn't. I think everyone is still actively testing all of this out, but the expectation is likely closer to zero than Solana, for example. I think there's probably going to be an assumption that at least the base rate is going to be lower than Ethereum staking. That being said, it depends on what's in the market at any point in time. Bitcoin is not a proof-of-stake protocol, so the rewards will have to be given out by another protocol that wants to stake for some reason, whether that be security or liquidity or a combination of the two. And it doesn't have to necessarily be Babylon as well, right? But I mean, creating like a staking functionality for a proof-of-work asset is TBD. But if it is like the not your keys, not your crypto folks, and then you don't want to sell it at all, but you trust the staking protocol, then you would be comfortable with 1% if you don't plan on selling it for the next 10 years or something. So,
being the lowest cost of capital asset as Bitcoin is right now is a competitive advantage, but it won't be that way. There's no reason Bitcoin should be the lowest cost of capital asset longer term. ETH has a higher cost of capital right now than Bitcoin, as probably does Solana and a couple other native tokens of big alternative layer ones. But once Bitcoin becomes natively integrated within those ecosystems and is competitive as collateral with all of these, I think Bitcoin will be preferred almost certainly.
Yeah, agree with all points. I mean, if the yield is too high, I get scared. I think everyone else gets scared. If you don't know where the yield is coming from, you are the yield. So it's okay to keep it small. It's Bitcoin we're talking about.
Yep, agree. So I think it's a good opportunity for us. People have very low expectation. Anything greater or equal to zero, we can potentially convince a lot of capital. Given that they can be convinced that their Bitcoin is secured, and then so I think it actually didn't take too much convincing for Bitcoin holders to join Babylon, for example, because they can be convinced that it's actually relatively safe. I could see it in the script. So I think that takes quite a lot of pressure off of us. I cannot sponsor 300% APY just by us. So I think, but it's definitely a good start. Yeah.
All right. Final quick question to wrap up this panel. Any alpha? Any upcoming exciting things you guys want to share? Maybe go through. You can chill yourself a little bit.
We have a 2-day event starting tomorrow. Not necessarily any product or technical alpha, but we will be here at the Bitcoin Renaissance. So feel free to come by. It's at Summit in Denver.
I would say Lombard's LBTC is on a lot of EVM chains right now, but we're just in the process of expanding to our first non-EVM, which I'm quite excited about. Sui will be out here within the next week or two, and then Solana very shortly after that. Both, I think, two of the two ecosystems that are ripe for DeFi innovation, in addition to Ethereum mainnet and Base, and hopefully Bitcoin native ecosystems.
I feel like we're all kind of fighting for the same TVL, so maybe we could try to find a way to work together. But we will be on Solana as well, launching in mid-March. So keep an eye out. zenBTC official is our Twitter.
We just launched a product called zenBTC.bnb, very original name. So essentially allowing Bitcoin holders to participate in Binance Launch Pool. So Binance Launch Pool, traditionally, the APY is about 300%. It's actually true. So with Redstone joining a launch pool, we try to capitalize on that, just going to farm a lot of red token and allow it, and also allowing Bitcoin holders to participate in that. So permissionlessly as well. So that is quite exciting.
All right, I want to thank all of you for being on the panel and everyone else for listening in. Thanks.